The performance of equity markets has been characterized by elevated volatility in the last 1 month. Foreign funds were the big sellers in November amid Fed's tapering and strengthening of the US dollar index. The detection of new virus variant at the end of November further weighed on market sentiment and battered the stocks down. The stock price of some of the leading companies have corrected far more than what is reasonable in relation to their fundamentals. Having fallen 15% from its 52-week high price, State Bank of India is one such stock. At current price, the bank is being valued below its FY23 estimated core book value. Current valuation implies that an investor buying SBI stock at this price is getting its valuable subsidiaries for almost free of cost. But then the low valuation cannot be the only reason to consider SBI, as it has been a value stock for very long now. The significant improvement in SBI's performance, supported by the end of bad asset quality cycle, are the key reasons for our optimism. Over past many years, SBI had been grappling with asset quality issues arising out of its corporate exposure. But with legacy corporate stressed accounts fully identified and well provided for, the asset quality cycle has turned favorable for the bank. It is reflected in the bank's GNPA ratio that has declined from the peak of 10.9% in FY18 to 4.9% in Q2 FY22. But is the falling GPA the only reason for our optimism? Not really. In fact, GNPAs have trended lower for all corporate lenders with the implementation of the Insolvency and Bankruptcy Code and the strengthening of the resolution framework. We are more enthused by the fact that the bad loan formation has slowed. SBI's slippage ratio, which had moderated in the last couple of years, fell to a record low of 0.66% in Q2 FY22, lower than even the slippage ratio of large private banks HDFC, ICICI Bank and even Kotak Bank. This was aided by lower slippages in the corporate segment and a resilient performance demonstrated by the retail segment in a pandemic year. Restructured loans stood at 30,312 crores, a mere 1.2% of the loan book as of September. Thanks to low slippages, credit cost was just at 0.43% in Q2 FY22, and provision coverage ratio improved to 70% as of end of September 21 from 45% in FY17. Overall, SBI's asset quality has not only improved significantly, but it is also trending better relative to private peers in the current fiscal year. SBI's net profit grew by 41% in FY21, a significant fall in credit costs, provisions that were the key drivers of earnings growth in FY21. The bank's credit costs stood at 1.12% in FY21, and in the first half of FY22 it has been just 0.61%. This means there is high probability of credit costs to undershoot in FY22 as well, and bank's net profit is expected to rise by more than 30% in FY22 as well. While lower provisions are expected to drive the profit in the current fiscal, we see loan growth improve and drive SBI's performance in FY23. Despite robust growth in retail book, SBI's overall loan growth has remained muted due to weak credit demand from corporates. For the banking industry as a whole, corporate credit growth has remained in low single digits over the last 7 years due to the absence of private investments and deleveraging done by the corporates. However, this may change in the coming year. Strong demand in the post-pandemic era can lead to increase in capacity utilization of industries and propel private investment-related credit demand. Also, the government's thrust on capital expenditure should aid the revival of the Capex cycle. The kick-starting of Capex cycle will lead to substantial valuation re-rating of SBI, and the stock could trade materially above long-term average valuation. The goal of 5 trillion economy cannot be achieved with just consumption demand. It has to be supplemented by equally strong investment demand. While the direction is set and certain, the timing of revival of investment demand is unknown. And precisely for this reason, SBI is still available at an attractive valuation, presenting a good opportunity to investors to accumulate the stock for the next leg of re-rating.